Hey guys, welcome back to the channel. So it's no longer a secret that real estate is an amazing investment. However, many investors are still not using it to its full potential. Today, we're talking about how we're gonna pay little to no capital gains taxes using real estate. Please hit the like button and subscribe button if you haven't already. We have tons of free educational content on our YouTube channel, in the video library, and more coming out every single week to make you the most educated real estate investor you can be. So what are capital gains? Basically, if you bought an asset for one price and then you sell it for a higher price, your capital has gained value and therefore you will owe taxes on that gain. There are two different forms of capital gains taxes, short-term and long-term. If you own the asset for less than a year and then sell, that profit is taxed as ordinary income, just like your income from your W-2 job would be. However, if you hold an asset for more than 1 year and sell it, you're now gonna be in a lower tax rate called the long-term capital gains tax. Of course, it's a no-brainer to try to end up in the long-term category, but as real estate investors, we can do more. We can make the long-term capital gains tax even lower or non-existent with a few creative strategies. Here are 7 creative strategies to avoid or minimize your capital gains taxes. Number 1, as we talked about before, hold onto your properties for at least 1 year. The profit you make in a sale is going to be subject to short-term capital gains taxes. Think house flippers if you only hold that house for less than a year. You could avoid that short-term capital gains tax and move it into the long-term category by simply stabilizing the property with a tenant and renting it out for 1 year. You could then sell this property after the 1 year and the tenant's lease is over. So if you're a house flipper, you might also want to become a 1-year landlord so that you end up in that long-term capital gains bucket and you pay a lot less in taxes. Tip number 2, live in your property for at least 2 years. When I learned about this tax strategy, it really blew my mind. There's something called the home sale gain exclusion, which says when a primary residence is sold, up to $250,000 in capital gains can be excluded from taxation as long as you lived in the property for 2 of the last 5 years. That limit increases to $500,000. That's right, $500,000 for married couples. So you can technically buy a primary residence every 2 years over the course of your life and roll over those gains to bigger and better homes tax-free, or just take the money in cash, tax-free. This really makes me think about our government and how badly they want people to achieve the American dream, starting with a starter home and slowly building up to maybe a 5-bedroom home in order to raise a family. It's pretty cool when you think about why this policy was made. You can also do renovations while living in the property to make it appreciate more in value. Savvy investors often call this the live-in flip strategy. Then when you go to sell, you're gonna qualify for that home sale gain exemption, and boom, you've just created a lot of value and you're gonna get it all tax-free. Strategy number 3, the 1031 exchange. So on the surface, the 1031 exchange is basically exchanging one investment property for another property and deferring the capital gains. You can then use the 1031 exchange as many times as you want, so you could technically defer gains over and over forever. I'm not gonna go into too much depth here about the 1031 exchange because I'm gonna link another video right here that's gonna take you to an in-depth analysis of the 1031 exchange and tell you all the details about how it works. Strategy number 4 is buying real estate inside of a self-directed Roth IRA. So this strategy also really caught my attention when I first heard about it because I have a Roth IRA myself. I thought it was pretty cool buying stocks and ETFs inside of a Roth IRA due to the tax-free growth it provides, but you can do it with real estate as well. Just make sure you're abiding by all the rules of self-directed retirement accounts, including a self-directed Roth IRA, but all your gains on appreciation and income through your real estate will be tax-free when you retire when using this strategy. Strategy number 5 is going to be recording all capital improvement costs on the property that increase the tax basis. This strategy is a little bit nuanced when trying to minimize capital gains, so let me explain. To start, you'll want to keep really good records of all capital improvement projects you do while owning the property because those costs can be added onto the cost basis of the property and narrow that gap when you pay capital gains. The nuance to this strategy though is that you don't want to go out and make capital improvements on the property just to increase the value for fun, because then you'll command a higher price for the property and end up with the same spread on capital gains. Just keep really good records of a new roof and how much that costs, or a new hot water heater and the costs associated with that, and it'll help you out in the future on taxes. Just trust me. Okay, strategy number 6 is selling your property when your income is low. I don't know about you guys, but I plan on retiring with more income than I have now, but that doesn't mean there aren't dips in net worth and earnings throughout one's career. If you find yourself in a situation where you're making less than $39,375 a year in adjusted gross income and have a property that you want to get rid of, go ahead and sell it. And by being under the income threshold, you won't owe any capital gains taxes on those profits. Strategy 7, we can gift properties to our family members after our death. If your estate plan is to transfer some wealth to your children, you've come to the right place, and this strategy might be for you. If you give your children real estate after you die, the tax basis on that is going to get stepped up to the fair market value of the property, and the capital gains taxes become no longer applicable if your child sells the home for the same amount as that stepped up tax basis. Another way to avoid capital gains taxes is to give real estate to your children while you're still alive, have your children live in it for 2 of the previous 5 years before the sale, and then they can sell the property and they'll realize all those gains tax-free. Chuck Norris, one of my favorite actors, said, between income taxes and employment taxes, capital gains taxes, estate taxes, corporate taxes, property taxes, and social security taxes, we're being taxed to death. Alright guys, that's it for today's video. If you have any questions about anything that was explained, please leave me a comment below. Smash that like button, and remember, get creative and educate yourself in real estate to make sure you're using the asset class to its fullest potential. Myself and the Rent to Retirement team look forward to working with you. I'll see you next week.